Good afternoon, Delphi community. This is Fox Holt, VP of Biz Dev at Delphi, coming at you today from Sanya, Hainan. I'm on a little vacation with the family, but was really excited to talk with this community about token velocity. It's a concept that I believe is not looked at enough when valuing tokens. I wanted to talk about what it is, token velocity, how it's applied to cryptocurrency as well as fiat-based currencies, and talk a little bit about prediction market dApps in general. I don't want to focus on just Delphi. This is prediction market dApps in general. Obviously, Delphi is one of those. So token velocity is the time period in which a consumer or business buys a token, stores it in the wallet, uses the token, and then relinquishes it or sells it back to the market. So basically the time between buy and sell. Very fast token velocities, in my opinion, are very bad because it leads to less scarcity. There's no scarcity, then there's no increase in price. So this is a concept that's been studied tremendously by monetary policy officials like the US Fed. They have studied and proven time and time again that increases in token velocity. So increase in token velocity means the money's in the consumer's bank account wallet for a shorter amount of time period. So that dollar's moving through the economy much faster. So increases in currency velocity leads to inflation. So inflation basically means the dollar can buy less goods. The dollar is worth less. This is the same concept that should be applied to tokens. Bitcoin is the perfect example of a token with a very slow token velocity. A lot of people are buying that token and just holding it forever. They have never selling it, never relinquishing it back to the market, thus creating scarcity. Okay. Prediction markets, diving into that platform. In my opinion, prediction market dApps, their tokens will have very slow token velocities compared to most other dApps. So number one, it's a consumer-based dApp. Why is that important? Well, businesses will view the holding of a token as working capital. Working capital is a bad thing for businesses. It increases, or let's say decreases the amount of cash getting into the investors' wallets. So they're going to want to minimize their working capital. It's very standard. And so the time of which they want to buy that token and then relinquish that token, use that token, sell that token back to the market is going to be very short. And so it's going to have a very fast token velocity. Consumers, on the other hand, i.e. prediction markets, most of the users, will not be that sophisticated. We don't view it as working capital. It's just part of the value, right? It's part of our value. So we don't, want to really get rid of the tokens that fast in general. Secondly, some of the prediction markets take a long time. One of the most popular prediction markets is, will Donald Trump be impeached before his tenure ends? So you buy the token, you hold it, you invest it in that prediction market, and it could be years before, hopefully not years, hopefully he gets impeached sooner, but it could be years before that token is then relinquished back to that community, back to the market. So very slow token velocity. That's all I had to talk about today, but I hope that was a good explanation. I hope that cleared some things. If you're not thinking about token velocity when you're investing, you're making a mistake, in my opinion. Please think about that. That's a huge thing. And in my opinion, it's one of the greatest things going for prediction market dApps compared to a lot of other investments. And one of the big reasons that I'm at Delphi. So with that, thank you, and look more from us. Thanks.